Alex just landed in Japan. He walks up to the currency exchange counter, hands over $500, and gets back a pile of Japanese yen. He counts it. It adds up to the equivalent of $431, $69, taken in fees and exchange charges, before he even made it to his hotel. Next month, he's flying to France. The month after, Brazil. Every country, a different currency. Every border, another chunk of money disappears. And somewhere on the way to his hotel, Alex asks something most people have asked at least once. What if the entire world just used one currency? No exchange counters, no conversion fees, no $69 gone before you've unpacked your bag. It sounds like the most obvious idea in the world, so why hasn't anyone done it? Actually, in one part of the world, they already did. 20 countries across Europe share the same currency, the euro. No exchange rate between France and Germany, no conversion fee between Spain and Italy. One coin, one note. Works everywhere. When the euro launched, it made things genuinely easier. Businesses could sell across borders without worrying about exchange rates eating into their profits. A French company selling to a German customer didn't have to think about currency at all. Trade between those countries grew. The system worked. And if it worked for 20 countries, why not the entire planet? Picture that world for a moment. Alex flies to Tokyo. Same money, no counter, no fee, no math. A small business in Nigeria sells handmade goods to customers in Canada. No currency risk, no conversion cost, no losing a percentage every time money crosses a border. Travelers spend freely. Companies trade freely. Workers sending money home to family in another country keep more of what they earned. The whole global economy becomes faster, simpler, and connected in a way it never has been before. It sounds like a genuinely better system. And then the problems begin to show up. A country's currency isn't just for buying things. It's a tool. When a country's economy slows down, when people start losing jobs, and businesses start struggling, the country's central bank can lower interest rates. Lower interest rates make it cheaper to borrow money. Businesses take out loans. They hire people. They invest. Slowly, the economy starts moving again. And when a different country's economy is growing too fast, when prices are rising and things are getting out of control, that country's central bank raises interest rates to slow things down. Different countries, different situations, different settings on the dial. But with one global currency, there's only one central bank. One dial. Set it to help the struggling country, and the booming country overheats. Set it to calm the booming country, and the struggling one gets worse. Someone always loses, and there's no way around it. This isn't a theory. It already happened. Greece, 2010. Greece had borrowed a lot of money over many years, and then, suddenly, lenders lost confidence that Greece could pay it back. Now, normally, a country in this situation has a very useful option. It lets its own currency get weaker. When a country's money is worth less compared to other currencies, everything made in that country becomes cheaper for people in other countries to buy. Foreign tourists get more for their money, so more of them visit. Foreign companies can hire locally at lower cost, so they invest more. Slowly, the country starts earning again. It's one of the most reliable ways an economy can recover from a crash. Greece couldn't use it. It was part of the euro. And the euro belongs to 20 countries, most of which were doing fine at the time. Greece alone couldn't weaken the euro. That decision belonged to a central bank managing an entire continent, and the rest of that continent didn't need a weaker currency. So the recovery tool that Greece needed most simply wasn't available. The only option left was cutting spending. Government wages were reduced, pensions were cut, public services shrank, and the economy didn't recover. It got smaller. Unemployment hit 27%, more than 1 in 4 people out of work. Young, educated Greeks left by the hundreds of thousands, looking for work in other countries. It took Greece nearly 10 years to get back to where it was before the crisis started, not just because of bad decisions Greece made, but because one of the most important recovery tools in existence was gone. Now think about that situation. Not for one country inside a regional group, but for every country on Earth, all sharing one global currency. A small economy hits a crisis. The global central bank is focused on the world's largest economies, And that small country has no lever to pull, no dial to turn, no tool to reach for. It just has to wait. It assumes that if money looks the same everywhere, the economies will become the same. They won't. Germany has decades of industrial development built up over generations. Norway has enormous oil wealth. Some countries are growing fast. Others are still building basic roads and schools. These differences didn't come from having different currencies. They come from history, geography, natural resources, education systems, and 100 other things that printing a new symbol on a coin cannot change. A country's own currency acts more like a shock absorber. When exports drop, when a recession hits, when jobs disappear, the currency can weaken, reduce costs, and help the country compete again. Without it, every economic shock hits directly. There's nothing sitting between the problem and the people living through it. The US dollar already works as the world's unofficial global currency, in a way. Many countries tie the value of their own money to it, and whenever the US raises interest rates to deal with American inflation, those countries feel it too. Higher borrowing costs, slower growth, all because of a decision made for a different economy, thousands of miles away. One currency, one set of rules, applied to situations that have nothing in common. A single global currency would make life easier for travelers. It would cut costs for businesses trading across borders. It would save billions in fees every year. But it would also take away the one tool that gives a struggling country room to recover on its own terms. The world has hundreds of currencies, not because the idea of combining them never occurred to anyone. It has hundreds of currencies because every economy is different, and different economies, at different times, facing different problems, need different tools. The $69 Alex lost at that counter is a real cost, and the reason it exists is just as real.